3 times, Warren Buffett got it wrong. Shocking investment mistakes. Welcome to the Investors Community channel. If you enjoy our content, be sure to hit the like button and subscribe for more valuable insights. When we think of Warren Buffett, we think of legendary investment success. Known as the Oracle of Omaha, Buffett has built a fortune and a reputation on his ability to pick winning stocks, often spotting lucrative opportunities well before anyone else. But even the best investors sometimes get it wrong. In fact, Buffett himself has been refreshingly open about his mistakes, acknowledging that not all of his investments have gone as planned. Here we'll look at 3 notable times Buffett got it wrong, and more importantly, what we can learn from these surprising missteps. Now you might be thinking, a $433 million loss? That's a rounding error for someone like Warren Buffett. And you'd be right. But here's the thing, Buffett didn't pay for Dexter Shoe Company with cash. He used Berkshire Hathaway stock. And this is where the story gets really interesting. You see, when a company does well, its stock price usually goes up. Berkshire Hathaway stock has a long history of incredible performance, often outpacing the overall market. So those shares that Buffett used to buy Dexter, they didn't just sit there at $433 million. Over time, they increased in value significantly. By the time Buffett publicly acknowledged the Dexter Shoe Company investment as a mistake, those shares were worth an estimated $3.5 billion. That's right, what started as a $433 million acquisition turned into a multi-billion-dollar blunder because of the opportunity cost. Imagine owning a piece of Berkshire Hathaway back then. You'd be sitting on some serious gains today. But those gains were essentially wiped out by the Dexter deal. It's like trading a winning lottery ticket for a bunch of shoes that quickly went out of style. Founded in 1958, Dexter was a well-established player in the American shoe market. They were known for their quality craftsmanship and had a loyal customer base, especially in the men's dress and work shoe categories. What's more, Dexter was profitable. They weren't some struggling company on the verge of bankruptcy. Buffett, with his value investing philosophy, was drawn to Dexter's consistent earnings and strong market position. He saw it as a classic buy-and-hold opportunity, a company with a durable competitive advantage, or so he thought. But Buffett missed a critical detail, a detail that would ultimately unravel the entire investment thesis: the rise of globalization and low-cost manufacturing. At the time of the acquisition in 1993, the footwear industry was undergoing a massive transformation. Shoe production was rapidly shifting from developed countries like the United States to developing nations, particularly in Asia. Countries like China and Vietnam were becoming manufacturing powerhouses, offering significantly lower labor costs and fewer regulations. This allowed companies to produce shoes at a fraction of the cost, putting immense pressure on traditional American shoemakers like Dexter. Buffett, despite his deep understanding of business, failed to fully grasp the magnitude of this global shift. He underestimated the speed and impact of low-cost imports flooding the U.S. market. American consumers, presented with cheaper alternatives that were often comparable in quality, began choosing foreign-made shoes over Dexter's offerings. Dexter, despite its legacy and reputation, couldn't compete on price. Their higher labor and production costs made it impossible to match the prices offered by competitors importing from Asia. In the end, Dexter Shoe Company, once a seemingly stable and profitable business, was absorbed by Berkshire Hathaway and effectively ceased to exist as an independent entity. Let's rewind to 2006. The global economy was booming, and Tesco was at the top of its game. Founded in 1919, Tesco had grown to become one of the largest retailers in the world. Buffett saw an opportunity in Tesco. Berkshire Hathaway began acquiring shares, amassing a significant stake. Tesco's stock price rose steadily and their business expanded. But beneath the surface, cracks were beginning to appear. Competition intensified with the rise of Aldi and Lidl. And then came the hammer blow, a major accounting scandal. In 2014, Tesco admitted to overstating its profits by £263 million. Tesco's stock price plummeted, wiping out billions in market value. In 2014, Buffett decided to cut his losses. Berkshire Hathaway sold its entire stake at a significant loss. Buffett's Tesco experience highlights the importance of recognizing and acting on red flags early. So, what can we learn from Buffett's costly misjudgment? Pay attention to red flags. These can manifest in various forms: declining earnings, management turmoil, or accounting irregularities. Chapter 3. IBM, The Perils of Straying from Your Circle of Competence. For decades, Warren Buffett had a well-defined approach to investing. Invest in what you know. He famously avoided investing in technology companies, arguing that he didn't fully understand their businesses or the rapidly evolving tech landscape. Buffett preferred companies with simple, easy-to-understand business models, strong competitive advantages, and predictable cash flows. This approach served him incredibly well, allowing him to identify undervalued companies and generate consistent returns over the long term. But in 2011, Buffett made a surprising move that seemed to contradict his long-held investment philosophy. He announced that Berkshire Hathaway had acquired a significant stake in IBM, one of the world's oldest and largest technology companies, investing a staggering $10 billion. The investment sent ripples through the financial world. Investors and analysts were puzzled. Why would Buffett, the staunch advocate for staying within one circle of competence, dive headfirst into a sector he had long avoided? Buffett's rationale for the IBM investment was multifaceted. He believed that IBM, despite its age and legacy as a hardware giant, was well positioned to capitalize on the growing demand for cloud computing and software services. IBM had been aggressively shifting its focus from hardware to software and services, aiming to become a leader in these high-margin recurring revenue businesses. Buffett was also drawn to IBM's strong brand recognition, global reach, and history of innovation. He saw IBM as a value play, believing that the market had undervalued their long-term growth potential. Initially, the investment seemed promising. IBM's stock price rose, and their transition to a cloud and software-centric business model appeared to be gaining traction. But as the years passed, IBM's transformation proved more challenging than anticipated. The tech landscape was evolving at an unprecedented pace, and new competitors emerged, challenging IBM's dominance. Companies like Amazon, Microsoft, and Google were rapidly gaining ground in the cloud computing arena, offering innovative solutions and aggressively undercutting IBM on price. IBM struggled to keep up. Their legacy businesses continued to decline, and their cloud and software offerings, while growing, couldn't fully offset the losses. IBM's stock price stagnated, and their once commanding market share began to erode. By 2017, Buffett began to express doubts about his IBM investment. He acknowledged that the company was facing significant challenges and that he had misjudged the competitive dynamics of the cloud computing market. In 2018, Berkshire Hathaway began selling off its shares in IBM, eventually divesting almost its entire stake. The sale marked a rare public admission of defeat for Buffett, who had long prided himself on his ability to identify undervalued companies with durable competitive advantages. Buffett's IBM misadventure serves as a cautionary tale about the perils of straying from your circle of competence. Even the most successful investors make mistakes. Buffett's failures are especially instructive because he's open about them, viewing each misstep as a chance to learn and improve his strategy. Let's look at a few overarching lessons these stories provide for all investors. Stay informed and be flexible. Markets and industries are always evolving. What works today may not work tomorrow, especially in sectors with high competition or rapid innovation. Investors need to stay informed about both company performance and broader industry trends, and they need to be ready to pivot when the landscape changes. Set clear criteria for selling. Buffett's mistake with Tesco reveals how important it is to have an exit strategy. When clear red flags appear, consider whether it's worth staying invested. Many investors hold on to stocks out of a desire to wait for a turnaround, but this can be risky. Setting predetermined criteria for selling can help investors make more objective decisions and avoid costly mistakes. Invest in what you understand. Buffett's IBM investment serves as a reminder that it's best to stick to what you know. Before buying into a new sector or company, ensure you understand its fundamentals, growth prospects, and any challenges it might face. As IBM showed, even well-known companies in fast-changing industries can face steep declines if they fail to adapt. Learn from every investment. Buffett's ability to reflect on his mistakes is part of what makes him such a respected figure in finance. Every investment, win or lose, provides an opportunity to learn. By reviewing what went right or wrong, investors can sharpen their strategies and make more informed choices in the future. Conclusion: embracing the ups and downs. Investing is never a straight path, even for legends like Warren Buffett. His mistakes remind us that no one has a perfect track record and that failure is part of the journey. By studying these mistakes and taking lessons from them, we can improve our own strategies and ideally, avoid similar pitfalls. See you in the next video. Don't forget to subscribe to not miss out on more helpful videos.